Coming up on the show, the economy turns a corner as Australia escapes the per capita recession.
The overall trend, the picture that you get around the economy is one that definitely is improving a little, but off a very low base.
And auction season in full swing as the RBA's rate cut reverses the property downturn.
It seems that the February rate cut was almost like a pilot pulling a plane out of a tailspin.
Also on the show, calls to end taxpayer subsidies for the country's largest coal-fired power station.
They're really no longer fit for purpose, and consumers are paying for that, both as energy consumers and higher bills, but also as taxpayers.
Welcome to Close of Business. I'm Alicia Barry. The longest per capita recession in decades has finally ended, thanks to the fastest quarterly growth in 2 years. Treasurer Jim Chalmers says the economy has turned a corner, and as Nadia Daly reports, it comes in part due to a lift in household spending.
Life is back in the economy. Living standards are recovering and Australians are no longer going backwards after 21 months. Despite the green shoots, it's touch and go for some businesses.
People are looking for promotional stock, and instead of buying 2 packets of Tim Tams, they buy 1.
And how's business been for you lately?
Yeah, it's okay. It's not as busy as it used to be.
Cappuccino, latte, 10 to 15%. Our revenue is dropped from at least 2 years. I think this cost of living is a big hit. We've been finding our regular customers spending a bit less.
But that could change with pay packets now outpacing prices.
Hopefully 2025 will be just a little bit better. It started okay, so let's see how we go.
The economy's growing at the fastest pace in 2 years, expanding 0.6% in the December quarter and 1.3% through the year. Spending on essentials dominated, although households also splashed out on Black Friday sales, concert and sporting tickets. But consumers remain cautious, saving some of that improved income. Private investment also rose, led by renewable and mining projects. And government spending and investment also boosted economic growth.
So this is looking more and more like the soft landing that we've been planning for.
The only thing driving our economy right now is population growth and people working extra hours.
Productivity is still going backwards, but economist Nikki Hutley says the economy's heading in the right direction.
The overall trend, the picture that you get around the economy is one that definitely is improving a little, but off a very low base.
Our living standards are still lower than 5 years ago, but these figures show the worst is hopefully behind us, with Australia managing to bring down inflation and avoid a recession.
As for further interest rate cuts,
we've taken our foot a little bit off the brake. We haven't got our foot on the accelerator.
Despite the fact that the Reserve Bank remains very cautious about the outlook for further interest rate cuts, I think the picture that's painted here helps support the case for more interest rate cuts this year. Barring anything crazy going on. Obviously the world is a highly uncertain place at the moment.
A lot of that uncertainty centres around Donald Trump's trade war, which could threaten Australia's economic recovery. Back home, flower shop owner Mohammed Alamuddin is ready for whatever comes next.
It's getting harder and harder and harder, and of course the cost of living too. So as a florist, they're luxury items. You don't really have to have them on the table.
A little bit of luxury becoming more affordable in a growing economy.
Minutes from the RBA's last meeting show its decision to cut rates was a close one. Board members worried that lowering the cash rate would reignite inflation as the labour market remains tight. But that was weighed against the risk of keeping policy too tight for too long. The board agreed one rate cut doesn't mean it's committed to delivering any more. The slump in the property market appears to be over. One interest rate cut from the Reserve Bank was enough to raise home prices nationally. House prices are up in all capital cities except for Darwin. As business editor Michael Yanda reports, this reverses one of the shortest and mildest property downturns on record.
something big. 850. 850.
I'm doubling, I'll give you 1.6.
1.6. Best of luck to you. 24, $1.6 million. That's the way to buy.
In suburbs around Australia, the property market's heating up as summer ends.
Are we on the market?
17.50. We are on the market.
We're on the market.
At 17.
And the traditional autumn selling season started with a bang.
And the property is all done. And welcome home. Sold to you. Congratulations.
This suburban house in Sydney's southwest just sold for $1.83 million at auction with 14 registered bidders. Agents say they're already seeing a lot more interest after the Reserve Bank started cutting interest rates, making it tougher for first home buyers like Shamam.
The second bid was already beyond the limit of what we felt was comfortable. So it's something that we have to think about for the next auction.
CoreLogic's Eliza Owen says the rate reductions staved off what was a short-lived property downturn.
It seems that the February rate cut was almost like a pilot pulling a plane out of a tailspin.
Prices rose 0.3% in February, with the national median home value now almost $816,000. While they're still cheaper than a year ago, homes in Melbourne and Hobart led the gains, along with properties in the regions, overtaking the booming markets of Perth, Adelaide and Brisbane. Darwin was the only city to go backwards.
Our modelling suggested this, that Sydney and Melbourne and generally markets that had a stronger reaction to rate rises were going to see the biggest benefit from a rate reduction.
Within days of the Reserve Bank's decision, would-be buyers had already seen an effect.
It is helpful, but at the same time, there's a correlation between when the interest rate goes down, the prices do go up. So it's a catch-22 on that one, yeah.
I did notice in the properties, as I've been looking at them, they've changed. So instead of being for sale at a certain price, they've all changed to the campaign is on hold or auction.
But the Reserve Bank boss wasn't too worried about the property market on the day she cut rates. Are you at all concerned that today's rate cut might spark the next leg up in that house price boom?
I don't think you can blame monetary policy on this, and certainly I don't think 25 basis points makes a huge difference.
And the news isn't all bleak for those looking to break into the market.
Our most expensive cities, Melbourne, Sydney, are probably as expensive as they will get relative to income. And that's because we reached that peak level of expensiveness when interest rates in the aftermath of the pandemic were realistically as low as we will ever see them.
Eliza Owen says even a few more rate cuts are unlikely to spark another major property boom.
Even if we saw a rate reduction of 1 percentage point over the year, that would probably boost purchasing capacity by about 12%, but it doesn't take the average purchasing capacity anywhere near where the median dwelling value is in Australia.
We've been furnished with this fine piece of documentation.
Despite the price uptick, there's also good news for those trying to buy their first home in Victoria.
Sold. Congratulations.
Over the past 5 years, Melbourne home values are only up about 8% compared to a broader uplift of around 30% across the country. Unit values haven't moved at all.
That's partly due to a weaker economy, leading many Victorians to head interstate. But there are other factors.
Melbourne's added about 30% more houses per person than we've seen here in Sydney.
The Victorian government's also been unique in dramatically increasing property taxes, especially on investors and empty homes.
Land tax is much higher than it once was, and I think that's contributed to some of the sort of rebalancing away from investors towards first home buyers.
Outside Victoria, most of Australia remains a seller's market.
We were hoping to get reserve, but we got way above what we were hoping, so we are grateful.
The gift that keeps on giving for those lucky enough to already own a slice of suburban paradise.
He once described cryptocurrency as a scam. But in an unexplained U-turn, US President Donald Trump has signed an executive order to create a strategic Bitcoin reserve. The White House says the reserve will be funded exclusively with Bitcoin seized in criminal and civil cases, so taxpayers won't be on the hook. The Treasury Department will also establish a US digital asset stockpile to hold other confiscated cryptocurrencies. For his reaction, I spoke to Morty Tolo, CEO of crypto exchange Elbait. Morty Tolo, welcome to Close of Business.
Hi Alicia, good to be here.
Morty, the reserve is no surprise, but Bitcoin fell immediately after the signing was announced. Why didn't traders like it?
I think this is because of the short-term misunderstanding that investors had based on the June 2024 bill which advocated for 1 million Bitcoin to be purchased. A lot of people were anticipating that the US government at the creation of the reserve would also announce that they would be purchasing a significant amount. That's not happening, and for that reason there has been a sharp sell-off.
So there were concerns that taxpayers would be essentially funding this Bitcoin reserve. That's not happening now. Do you think that played into the government's decision?
I think there has been a time where the crypto lobbying has pushed for crypto to be purchased and in various forms for different cryptocurrencies to be included. What is, I think, a very smart play on the administration is that they've taken the politically safe route, which is to announce the creation of the reserve, but without any sort of impact on the taxpayer dollars. Now, the key part here is it says budget neutral acquisition will be allowed. What this means is still quite unclear, but some anticipate that perhaps some of the Doge cuts that they've identified potentially may be going into the funding pool, if you will, or other mechanisms.
Donald Trump has performed essentially a 180-degree backflip on his views on crypto. Why should investors trust him now on crypto?
I think this time around, not only has he fully delved deep into the industry, he's got a company that he's affiliated with, World Liberty Financial, which holds a significant amount of Bitcoin and Ethereum. But this time around, he's surrounded by pro-industry players. He's got key advisors around him who are part of the industry. Many of his family members, Jared Kushner, his sons and daughters, are actively playing a key role in the digital currency. For them, I think this time around, it's not just an industry where back when he was president the first time, that the industry back then was quite, I would say, immature. It was still developing. This time around, there's ETFs and there is clear demand. And this sort of policy has also won him the votes. Many attribute his pro-crypto stance as the reason why he's even in the office.
Well, in December, you told me that if Donald Trump follows through with his policy promises, Bitcoin could rally all the way to $1 million US. It's around $87,000 a coin now, US. Is that still your view, $1 million?
Yes, I think in the short term, it makes sense why there was a sharp drop-off. I think in the medium to long term, this is a key importance here is it's basically elevated Bitcoin to the same status as gold. I anticipate other G20 nations around the world are going to be closely monitoring this, and I do expect a few additional countries in the next 24 months to announce their own. It's that game theory, if you will, that's going to drive the price higher as other nation states look to create their own, as the industry also becomes more institutionalized. One key factor to look here is the BlackRock Bitcoin ETF. It's their fastest growing ETF in history, and it's only 1 year old. the kind of growth rates right now that the industry is seeing, 1 million Bitcoin is not off the table. It's certainly possible, and this takes us one step closer to that.
Well, you mentioned Trump's own holdings, and of course he and his family have meme coins, but anyone who got in at the beginning have taken a big bath on those. Do you think there's any value in those meme coins?
I think the meme coin stuff has definitely hurt his image in the cryptocurrency circles. It's not seen as a positive thing at all. It's seen as a little bit of value extraction, peddling to the crowd here, if you will. And a lot of investors that have put money into the Trump coin and other related coins have lost a lot of money. And it's these sort of initiatives that do make investors question whether everything that he has said so far is based on whether it's good for America or it's good for his own personal wealth here. So what I want to see from the US government and from the president himself is less about himself and more about how the industry in the United States and even globally can develop further, and that is through new policies, new consumer protections, clear roadmaps. That's going to drive the industry forward, not further meme coins.
Mordi Tolo, thank you so much for your time.
Thanks, Alicia.
There are calls to end taxpayer subsidies for the country's largest coal-fired power station. Owned by Origin, the 40-year-old Eraring supplies New South Wales with a quarter of its electricity. But a new report says supporting Eraring with public funds is actually driving up electricity prices. As Rihanna Whitton reports, it's a claim rejected by Origin.
The nation's biggest coal-fired power generator was due to close this year. But it's still open after the New South Wales government agreed to underwrite Eraring's losses of up to $450 million until 2027.
This ensures that the transition to renewables can be delivered without exposing the people of New South Wales to blackouts or to price spikes.
But a new report is criticising that deal.
Each unit of Eraring is basically down for 2 months a year, especially in the last few years.
The report author says Eraring's performance highlights the unreliability of keeping the nation's coal-fired power stations on life support.
They're really no longer fit for purpose, and consumers are paying for that.
The Grattan Institute's Tony Wood agrees coal plant outages are becoming more frequent.
When we have had shortfalls of supply, partly due to the failure of coal-fired power station units, where prices have spiked because gas has entered the system.
As the major parties argue about how best to keep the lights on, the viability of Australia's ageing and increasingly costly coal-fired power stations is set to become a key federal election issue. The Coalition's nuclear plan relies on coal plants staying open longer until nuclear generation comes online from the mid-2030s. The Australian Energy Market Operator forecasts 90% of Australia's coal plants will close by 2035. Most experts say replacing coal with nuclear would take at least until the 2040s.
It is very problematic to suggest we can keep doing that into the time periods that will be necessary to align with the sort of nuclear power stations that the opposition is talking about.
The Coalition insists their plan is responsible and realistic.
Madam Speaker, we stood up...
But former New South Wales Liberal Treasurer Matt Keane, whose government previously rejected a proposal to keep Eraring open, is scathing about the Coalition's nuclear plan.
It will crowd out private sector investment, crowd out newer technologies that can deliver cheaper, more reliable power, and it's betting on a system that is totally government funded with higher prices.
In a statement, the owner of Eraring, Origin, said it supports the retirement of coal-fired power stations when there is sufficient replacement renewables and firming capacity online to keep the lights on. The energy giant also rejected criticism of Eraring's performance, saying the plant was available 84% of the time. Indeed, the data shows unplanned outages have continued to trend downwards. Origin says Eraring will close in 2029. Energy experts say that leaves the door open to further taxpayer assistance.
There will be difficult decisions to be made as to whether or not things are looking okay. That is, the renewables and other things to replace Eraring are in place. Alternatively, maybe they'll need to revisit it.
Stephanie Bashir is adamant Eraring should shut down in 2027.
We really have to focus on ensuring we close them on time. They're not working even as a band-aid.
A call to accelerate the transition to renewables.
Late on Friday, Star Entertainment announced it will receive a $53 million lifeline. Its Hong Kong joint venture partners will buy its stake in its Brisbane casino, pulling it back from the brink of collapse. The Australian share market has hit a 6-month low. The ASX 200 is now down 7% from its peak in mid-February. By the end of this trading week, the ASX 200 had dropped 2.7% and the All Ordinaries Index was down almost as much. For what was driving the market action, I spoke to Kyle Rodder from capital.com. Kyle, Wall Street appears to have gone from hope to panic. Is it just Trump's tariffs that have given investors an excuse to sell?
Primarily it's the tariffs, yes, and the fact that the tariffs now seem to be manifesting in some kind of slowing of economic activity. And even more to the point, there's a high degree of uncertainty now because of, what has been, at least on the surface, almost improvised trade policy over the last few weeks, that markets are finding it very difficult to price in the future. So on the one hand, the markets are now preparing for, maybe a fairly material downturn in the US economy if these sort of trade tariffs are applied as they are sort of being currently tabled. And then just more to the point, the confidence impact from the policy uncertainty alone is having an impact on, again, economic sentiment as well as investor sentiment. So largely this is about the trade war and the volatility that brings. And really until that kind of resolves itself, it's hard to see the markets picking up.
Yeah, it's really interesting because in the month after the election, the S&P 500 jumped more than 5% on the expectation that this new administration would bolster the US economy. But now, as you say, there are growth worries and even talk of stagflation in the US.
Yeah, exactly. And I think what was probably the misapprehension there was that the markets really bought into the idea of, tax cuts and deregulation, which would have, of course, been stimulatory and maybe even added to sort of this kind of productivity boom in the United States. And there was this kind of refrain amongst market participants that although there was, fairly bellicose rhetoric from the Trump administration, from President Trump himself about the trade war, that it was all just a negotiating tactic and that eventually there would be a compromise and, the worst wouldn't come to pass. Now, that could still be the case, but the concern now is that the tariffs being proposed are much larger than even the ones applied during his first administration. He seems to be far more adamant to shake up the global trading system. And again, if nothing else, it's just the uncertainty alone that seems to be hitting consumer confidence, that is keeping businesses from investing and employing. And again, almost a sort of self-fulfilling nature of a slowdown now caused by just the uncertainty alone. So really, the markets had good reason to be bullish the first time, or when Trump was elected, but they just really underestimated his conviction in trying to shake up trade.
Yeah, and of course the tech stock rally has seen stocks like Nvidia sent to the stratosphere, but now the NASDAQ is on the verge of correction. Do you think the bears have returned for good, or is it just a case of still this uncertainty?
Well, there's two elements there. There's one, the fact that we saw such a significant run up, and going into this year, valuations were very stretched. And whenever you do see multiples that high, investors or the markets themselves can be a little bit prone to shocks, and we have seen one of those. The other element, of course, is the sentiment factor, and then in addition to that as well, that the tariffs that we're talking about would really be a significant impact to some of these companies and their profit margins, really on the basis that they import a lot of raw materials, they import a lot of the inputs that go into their products, and there's this ongoing question about what role microchips might play or chips might play in the trade war, and whether there'll be a tit-for-tat element that will really target the technology sector of China, or China targeting the US technology sector as well. So we're really seeing this kind of deflation in multiples now, money moving out of the US into other markets, and now on top of that too, a downgrade in earnings estimates on the basis that we could be moving into a much higher cost environment for a lot of US companies.
And of course, the Australian share market has been caught up in this sell-off.
Yeah, and again, we're just a small economy with a very sensitive market to global economic activity and global trade flows. And quite simply, if global trade slows down or weakens, that's going to weaken the Australian economy. And you talk about a situation where equity multiples were very, very elevated, arguably with little fundamental impetus to justify it. The ASX 200 is a great example, trading at extreme valuations relative to recent history. But if you look at the recent earnings season, profit growth was fairly modest, and there are these downside risks now emerging because of a slower economic backdrop, which will hurt the miners, which will hurt those other sectors which are sensitive to global economic activity. So we're really seeing a significant re-rating for the ASX 200. Arguably, it's a little bit overdue because the run-up in the first place wasn't tied to the market's fundamentals, but we're down almost 10% ourselves since the recent highs. And again, as long as there's this uncertainty about global trade, it's difficult to imagine a scenario where market sentiment will pick up and we'll get sort of investors coming in to support the market.
Kyle Rodder, thank you so much for your insights.
Thank you.
The gender pay gap in Australian companies is narrowing, but not by much. Just 1 in 5 businesses have eliminated it. It's the second time the data's been published, revealing how individual companies have performed. Daniel Ziffer has the story.
For working men and women, different outcomes.
The national gender pay gap is 21.8%, which means that on average, for every dollar that a man earns, women earn 78 cents.
New data exposes the gap at every business with more than 100 staff.
56% of companies improved their gender pay gap in the last 12 months.
Qantas is celebrating International Women's Day by having more than 50 flights operated entirely by women. But for every dollar a man at Qantas makes, a woman, on average, earns just 64 cents. And at Jetstar, it's 54 cents.
I think the publication of the data is absolutely essential. It does accelerate change.
Brittany Carroll's story at pharmaceutical giant GSK shows how the gap can be narrowed.
It was about 6 weeks away from me going on parental leave and my dream role became available. My initial thoughts were, I don't even think I can apply.
But she won the more senior, better paying job, and it was held for her until she came back. The company's human resources boss says narrowing the gap takes time.
So this data is a really positive step to be more transparent and to be able to have a better conversation with employees.
Since our interview, the global company has dropped diversity targets to avoid breaking the law in the United States, where President Trump has slammed programs that support the inclusion of marginalised groups. Experts say companies here must comply with Australian law.
And that's all from Close of Business. I'm Alicia Barry. Thanks so much for watching.